So yeah, here we are. Number 4 is buying on strength, not on weakness, or what might be known as chasing the market. Do you want to kick into that, David? Will I grab a sip of water?
I'll talk a little bit here. A lot of people, when they start hearing a lot of news about gold in the newspaper, often that's when they think, oh, they better jump in and buy, and that's often when the market has risen a lot already. So obviously the time to buy is on weakness, and it's quite a hard thing for people to do, because in August and September a lot of people were chasing the market a bit, and it went all the way up to 1900. But as of like in the beginning of November or October, when gold plunged down to 1500 and silver plunged down very briefly to $27 US, we got fewer orders, which is obviously you'd expect to get more orders, but because people fear that it could drop a lot further, people tend to back away. So it's hard. It is hard, and it's it comes down to fear and greed. But if you're not in the market, you should grab a position and have some cash for when it does get a lot weaker, and grab maybe third. But it is very hard to get your head around that.
And again, I guess we kind of answered that in the last question about the sort of simple technical indicators there. Go and have a look at that video, and that is a simple kind of a rundown. And there's many methods, and you can talk to many people that will come up with different ways and different systems and whatnot. But that 200-day moving average line is a useful way, just that if you get it there or thereabouts, the odds are that in the long run you're probably not going to regret things too much. So it has in the past. It's actually dropped down. There's been some big drops where you might have actually lost a bit initially, but it has actually in the long run generally bounced off that kind of 200-day moving average, the gold price. So we won't go into too much detail, just because you could sort of talk all day on that. But that video is on there, and that does explain things reasonably well. And obviously, fire us an email or give us a call if you want a few more thoughts on that, or on some of the other sort of technical measures and ways to look at, in terms of when you're going to enter the market, basically when you're going to buy.
I'll just say one thing on silver. Like about 2 months ago, silver was $45, $49 US an ounce, and it plunged down to 28, and now it's in the early mid-30s, but it's still in the lower area of what it was when it was 45. So we are, in my view, we are on a weaker side of the silver trade at the moment.
Guess the old adage, buy when people are selling and sell when people are buying, kind of holds true in this market then.
Yeah, it definitely does here, and I mean, as David said, we've got some good indicators we can follow ourselves. It's just simply how many visits are we getting to the website, and how many kind of quotes and things are we getting too, and that's probably as good a way to tell as any what the market's actually doing, and because people generally do things at the wrong time. So
yep.
If it's kind of quiet, the odds are it's probably quite a good time to be snaffling some. And I know David did himself quite recently as well. He got some silver. Maybe he fluked it, I don't know, but he got some when it dropped back there to about 20. What did it touch? $28 or so.
Yeah, around there. Right.
I think it was a fluke probably, but anyway.
Oh, it was definitely a fluke. But I'll take it, though.
It's pretty hard to get the exact bottom like that, but at least if you're buying when it's hard to do, but when you're buying when the price is dipping, in the long run you're probably going to be better off. That's
especially the fundamentals are. Fundamentally, gold and silver are on a rising trend. So think of the big picture. If you buy on weakness when you know the fundamentals are right, you should be right in the long run.